Welcome back to our next session, Classes of Business in Life Assurance. Right, classes of business and life insurance. A life insurance policy is an arrangement under which a person, in return for a provision being made for the rendering of a premium to that person, undertakes to meet insurance obligations in the event of a life event, health events, disability events, and death events from a fixed determinable date or at the request of the policyholder, but excludes a deposit with an institution authorized under the Banks Act of 1990, Act number 94 of 1990, the Mutual Banks Act 1993, Act number 124 of 1993, or the Cooperative Banks Act, Act number 40 of 2007. Participatory interests in a collective investment scheme are registered in the Collective Investment Schemes Control Act, Act 45 of 2002. Right, the classes of business in life insurance. We've got the following classes listed under life insurance products: assistance policy, a life risk policy, a life investment policy, a fund policy, a sinking fund policy, a long-term reinsurance policy. These are all detailed explanations of these classes of life insurance is provided in the next section as we move forward. Right, let's have a look at the following. In each of these classes of business, you will find life products as classified in Annexure A subcategory of the FSP. Long-term insurance products are found in the following subcategories. Right, let's look at the categories. Long-term insurance subcategory A, which is your assistance policies or funeral policies. Then you've got long-term insurance subcategory B1, which is life risk policies or life and disability insurance. Then you've got life insurance subcategory B1 stroke big A, which is your life risk policies, no or limited underwriting, which is typically something like an income protector insurance policy. Then you've got your life insurance subcategory B2, which is your life investment policies with a guarantee, typically endowment policies with a guaranteed minimum amount or a guaranteed annuity. And then you've got your long-term insurance subcategory B stroke big A, life insurance or investment policies provide for the premiums to be invested in a portfolio with no option by the policyholder to request change or amendments to that portfolio. And then the final category is long-term insurance subcategory C, life investment policies, which is endowment policies with no guarantee. Right, let's start with Unit 1. And in this unit, we will discuss the general principles of insurance planning and risk management. A very important section because the information here you will need to know in order to conduct your business correctly. Right, let's look at risk management. I've put up a risk map there for you in red. We've got identify the risk, number 1. So then once you've identified the risk, the second step B2 would be in blue, assess the risk. So go and discover how much risk you can take and what exactly the risk is about. 3 is in the gray block is communicate the risk. And then 4, which is then mitigate the risk in the green block. So that just gives you a general overview of how to classify risk. Now let's look at risk. Risk of death is unavoidable, and especially an economic threat if it's premature. So if a husband and a wife is married and they've got children and the husband dies prematurely and made no provisions, then obviously there's a heavy risk on the family. When an individual is exposed to heavy financial responsibilities, yet he had not had time to accumulate wealth to offset the financial needs of the survivors, life insurance would then be the tool to manage this risk. And it's one of the cheapest forms of providing then for and dealing with the loss of risk or of life, and cover the risk. Right, let's have a look at indemnity. Indemnity, the essence of insurance is the principle of indemnity, that the person who suffers a financial loss is placed in the same financial position after the loss as before the loss occurred. Right, so in a case of disability, one don't want to be in a better position financially than you were before the disability, because then people will injure themselves just to get disabled. And that's not what the purpose of insurance is. It is to put you in the same position that you were in before the loss, and not in a better position. Right, so he neither profits nor is disadvantaged by the loss. Right, what is insurance? Insurance or assurance, therefore, is a promise of compensation for specific potential future losses in exchange for a periodic payment. Insurance or assurance, you see I make a distinction between insurance and assurance because these two terms are used interchangeably, but assurance is the more correct term, being the assurance that you will get something on the life. Insurance is more for a dead item, which is a car or furniture. Is designed to protect the financial well-being of an individual, a company, or other entity in the case of unexpected loss. Some forms of assurance are required by law, while others are optional. Right, what is assurance or insurance? Let's continue with this one. Agreeing to the terms of an insurance policy creates a contract between the insured and the insurer. In the exchange for payments from the insured, called premiums, the insurer then agrees to pay the policyholder a sum of money upon the occurrence of a specific event. In most cases, the policyholder pays part of the loss, called the deductible, and the insurer pays the rest. Examples include car insurance, health insurance, disability insurance, life assurance, and business insurance in the short-term space, or business assurance in the life space. Right, law of contract. Right, what is law of contract? The meaning of contract is, it's important to understand the nature of a contract in the financial services industry because of the intangible nature of financial products and services. Briefly, a contract is an agreement made between the party concerned and with the intention to create an obligation or obligations. In this instance, the obligation will be on the insurer, which insure the insured. Right, what is a valid contract? There is an agreement for performance in the future by one or more of the parties. That is, one or more of them undertakes to give something or do something. The parties have legal capacity to contract. The parties seriously intend to enter into the contract. Although not all contracts must be in writing, it's important to note that an oral agreement is more difficult to prove in court. The contract is not contrary to the law, but public policy or good morals in its formation or purpose or performance is there. Right, termination of a contract. A contract may be terminated for one of the following reasons. The contract is void from the beginning. Right, in effect, the contract never took place for one reason or the other. An example is one of the parties was insane. There was no definite agreement with respect to the performance, or the performance was against any public policy. Or it is a voidable contract. This means that even though all the essential elements are present, there is an occurrence at the time of the conclusion of the contract that entitles one of the parties to cancel that contract. These occurrences include misrepresentation, duress, or undue influence. So if I was held by gunpoint to sign a contract, that is what they call duress, or undue influence, where I was influenced or forced, to sign the contract, then it's a voidable contract, and then it is an unenforceable contract. This means that the terms of the contract cannot be given effect to, which means the contract is basically illegal and there's no basis to have a contract. Right, so voidable contracts, to summarize, is a contract that is entered in under duress, undue influence, and or misrepresentation. Right, what is duress? Where a person does not enter into a contract voluntarily or freely, he may be entitled to terminate the contract if the following 4 elements are present. A reasonable fear is present, so this person fear their life if they don't sign the contract. The fear is caused by a threat to the party concerned or to his family. If you don't sign the contract, I will kill your son or daughter. The threat is imminent. It's something that will happen. And the threat obviously is illegal, because killing is not a legal reason to get a person into a contract. Undue influence. Undue influence occurs where the consent of a party to the contract is voluntary but has been unduly influenced by the words and or the conduct of the other party. Right, what is misrepresentation? Misrepresentation is the most likely form of delict or wrongdoing to occur in the financial services industry. It normally consists of a false statement of facts being made by one or other party to the contract to the other before or at the time of the conclusion of the contract. Misrepresentation may consist of either one or two things, which is a wrongful act or an omission. When a wrongful act or omission occur, it constitutes a delict of wrongdoing that entitles the aggrieved party, normally the client, to claim damages where it meets the requirements for liability under a delict. Right, requirements for a misrepresentation to be proved. Although there has not been many cases involving delectable liability of financial advisors, with the increase of consumer awareness, a more acute and active financial press, and legislation containing penalties designed to enforce ethical practices, there will be an increased number of financial advisors at risk should they not give their clients the best advice in the circumstances. All 5 of the following elements must be proved by the person claiming that a financial advisor is delectably liable on the ground of misrepresentation. Number 1 is an act or conduct, a wrongfulness, fault, a determinable result, and or causation. Right, vicarious liability of an employee. What does vicarious liability mean? Vicarious liability arises when a financial advisor is employed by a company or an organization. So you work for an FSP, the company or the organization that has employed the financial advisor is responsible for his actions where he acts within the scope of their employment contract. Even in situations where the financial advisor has acted outside of the scope of his employment contract and where he has acted negligently or fraudulently, the company or the organization may be liable. Now we've got a case in point, which is the ABSA versus DUR case, where a person that worked for ABSA, which was a regional manager, which is actually sad, gave advice to Mrs. DUR and invested her money into a scheme that was not approved by ABSA brokers. And in the effect is that she lost her money in the scheme, and then this person that worked for ABSA was then acting on behalf of ABSA, and Mrs. DUR believed him because of that, and she suffered loss. So she put a claim in and she won her case, and the company ABSA then paid out to Mrs. DUR her money, but then obviously the regional manager was held accountable for his actions by way of disciplinary action, and I think in the end he was also then dismissed off by ABSA brokers. Should a claim for damages arise due to a wrongful act on the part of the financial advisor and the company or organization is held responsible, the company or organization has a claim against the financial advisor to pay for the damages under his employment contract. The delectable liability of an independent broker. Now, an independent broker is liable under the law of delict for any wrongful act or omission which has resulted in a client suffering a loss. Now, that's different from a person working for a company. This guy works for himself. However, it's important to note that there is no vicarious liability in this instance, as the independent broker worked for themselves and not for a company or an organization. the independent broker is sued directly by the client in such circumstances. And that is why brokers need to have insurance in place in case they get sued so they can cover their losses. Right, indemnity or non-indemnity insurance. Two important forms of insurance have developed over the course of time, namely indemnity insurance and non-indemnity insurance. The original meaning attached to the term indemnity was specifically and simply to compensate for patrimonial or material loss. In indemnity insurance, a contract between the parties provides that the insurer will indemnify the insured for patrimonial loss or damage suffered as a result of happening or the event insured against. Important consequences are attached to the distinction between indemnity and non-indemnity insurance. Non-indemnity insurers are not entitled to claim a proportionate contribution by other insurers or to damage subrogation of the insured's right in respect of a loss. Right, what is insurable risk? For a risk to be insurable, several things need to be true. And this is also very important to know. The insurer must be able to charge a premium high enough to cover not only claims expenses, but also to cover the insured's expenses. In other words, the risk cannot be catastrophic or so large that the insurer could not hope to even pay for the loss. The nature of the loss must be definite and financially measurable. That is, there should not be room for argument as to whether or not payment is due, nor as to what amount the payment should be. The loss should be random in nature, else the insured may engage in an adverse selection or what they call anti-selection against the insurer. Uninsurable risk. Some risks are simply too great for an insurance company to take on. An uninsurable risk is a risk where the potential for loss is too high or where the insurance is considered illegal, criminal, and or prohibited by public policy. Another example of uninsurable risk is when a loss is considered as inevitable, so it will happen. In addition, insurance companies do not cover illegal acts or activities that are prohibited by public policy. Right, insurable interest. The idea of insurable interest is that the insured has an interest in the preservation of the things being insured, like his motor car, his house, or his own life. Insurable interest needs only be present at the inception of a life policy. An insurable interest exists in one's own life, the life of one's spouse, your children, brothers and sisters, parents, grandparents, grandchildren, etc. In fact, wherever there is a duty of support, an insurable interest is present. Insurable interest also exists on the life of one's debtor, one's partner, employer, or employee, or a fiancé, because there is a relationship there. Right, let's look at an example of an insurable interest. Example, Mike's neighbor is a young, reckless man who is 24 years of age and likes to go out partying until late almost every night. He is a poor driver and also drives under the influence regularly. He has already had 2 severe car accidents in the last year. Mike has no connection or relationship with this person. If the insurable interest clause did not exist, Mike could then take out a policy on his neighbor's life where he would stand a chance to gain the payout on the life cover amount on his neighbor when he died. However, this example is absence of an insurable interest, which will prevent then Mike from taking out a policy, as this would be a money-making scheme, because he knows that his neighbor is a risk taker. Right, let's look at insurable interest further. Generally, insurable interest exists in the following instances. A person has unlimited insurable interest in his own life. A husband and wife has unlimited insurable interest in each other's lives. Children may have an insurable interest in the lives of their parents if they are still dependent on them. Parents may have insurable interest in the lives of their children if they are dependent on the children. The amount of cover that can be taken on minor children's lives is limited and will be discussed in detail further. Engaged couples have insurable interest in each other's lives. A creditor has an insurable interest in the life of the debtor for the amount owed. A business partner have an insurable interest in the lives of another, as they may be held liable for debts after the partner's death. And an employer has an insurable interest in the life of an employee, as the company may suffer loss if the employee dies. Right, this basically concludes this part of our session. I'm just going to, on a diagram, quickly discuss with you the life insurance cycle or the planning process, because the next one we're going to move in will be the various life products, and that all forms part of your financial planning process that you as an advisor must work when you work in life insurance. Now, the first one there is determine current financial situation. So when you get to a client, you first need to discover what exactly does the client have and what do they need. Right, then once you know what their current situation is, you then develop your financial goals for the client, identify alternative courses of action, which means you will prepare one or two different quotations as to different options that you can offer them. You evaluate these alternatives. You consider their life situation, their personal values, the economic factors. Can they afford the product? How much can they afford? Is there risk? Is there time available that we can make use of time value of money? That's the fourth step. And the fifth step would then be to create and implement your financial action plan for the client. But once implemented, that's not where the process stops. That's where you as a financial planner stays with the client, and later on you go and review and revise this financial plan for them, because obviously there's going to be changes in economic and socio-political and in various aspects of legislation. So you need to adjust their portfolio accordingly. But thank you very much for attending this session. The next one will be Unit 2 that we'll discuss. See you then in Unit 2.